Good afternoon, everybody. Welcome to the Misfit Happy Hour. Today, I am joined by a very busy and special guest, Brian Shannon. Brian Shannon is the author of this fine book that I think a lot of you have picked up recently. So I wanted to see if I could capture an hour of his time, and he graciously has accepted. I haven't spoken to Brian before, but Brian, what I can say is that I have been a member of your room in the past. I've spent a couple of months in there checking out AlphaTrends, and I think it's a great service. You're a swing trader, and in our service, I cover a number of different time frames. We do a lot of scalping. We do a lot of short-term or mid-term types of trades that will go, a few days or a couple of weeks, and then we kind of have a long-term strategy. But we always leverage options. So we're not equity traders. But what I've found is the methodology, the Anchored VWAP that you teach and that you write about in your book is very, very helpful. And when we're always looking for things that can help us try and identify some type of an edge in our trading. There are so many things that are out there. So few of them work. When we find something that works and it's written and put together in a really cohesive way, in a way that's easily explainable, we love it. So big fan of your work, and even more so of the book. There are some things that I'd love to talk to you about in there that you go into detail about, that I wasn't really looking for or privy to until I read through the book. And we found some things in the last 10 days that you go over in your book that, from a scalping perspective, have really boosted the types of setups and trades that we look for. And we've really found some nice scalps based on some of that stuff that you've put in there. So again, thanks for coming on board.
Yeah, thank you for having me. And, I love hearing that. And Ron, the thing is that, the beauty of the Anchored VWAP is it's the truth of supply and demand based on whatever time frame you're looking at. As you just pointed out, using it for scalps. I sometimes show the E-minis, of the overnight E-minis, and, anchor a VWAP from the low and the high and watch those pinches develop. And it's the same exact thing for swing trades, even for investors. It's really, it's just a basic measurement of supply and demand. And that is the essence of, how stocks move and where we can find our edge.
Yep. We I don't know how much you know about the world that we have created over here is Wall Street Jesus, and wallstreetjesus.com. So we've got Jesus Dino who does a stream, and then we have Lucci Anand, and he does a Twitch stream as well as teach our master course. I'm a part of that. We have another educator, Chris Cady, who comes in and helps teach with psychology. So we have kind of a small universe and different way of going about things here. And one of the things that's really, really interesting is how your Anchored VWAP ties in a lot with what Lucci teaches, which is reading level 2 and having the ability to sandwich those things together. Just creates an amazing edge. So I'm just curious, is level 2 something that you've used from your past? And, are you comfortable with it? Do you like it?
I used to. We look like we're probably of about the same age, Ron, and I've been doing this, full time since 1991. So my days of obsessing over level 2 screen are well behind me.
Yeah.
It used to be a valuable tool. In particular, 20 years ago, when we kind of first had access to it, and the whole SOS thing, and
Yes.
the ETNs when they first came. But now there's a couple things. I've lost interest. My focus to watch the level 2 isn't there. My focus for the real short-term scalps, sometimes during the day I will find a trade in that time frame. Just happen to come upon it. I'm not necessarily seeking it out, and I think that's probably the best way to find them as well. But I think that, the beauty of it, as you said, is it can complement your work with what you're doing on the level two, and it helps reinforce what you see there, or help you call bullshit in what you're seeing in the level
Yes.
two, where there's so many, it's filled with lies. It's a place where the liars go, hold their cards up and say, here's what I'm holding, but I got pocket aces. You just don't know what their real game is. So it's again for all time frames, but I set a lot of alerts intraday. So I'm
Okay.
not sitting there watching, if I'm really engaged in a stock, then I'll watch it for a little while when I just first engage in the stock. But I'm not trying to figure out supply and demand and who's the axe. I don't know if people still do that anymore. But it's really about, where's supply and demand from that, in your world, scalping world, from that 10:36 a.m. high or that 2:38 p.m. low, and
Right.
where they come together and create that pinch. And in the afternoon, we get a break in either direction. And if it was tight enough, it tells us there's a real compression of energy, so that when it springs out of that compression, we can get involved right at the onset of that momentum move, and you can assist it with your level two, as you're saying. But most important to me is then I know I have a low risk place for my stop below the most recent relevant lower high for
Mhm.
the long, or above the most recent relevant lower high for the short side.
Yep. And I think that's where I think some of it, I share a lot of similarities in how you view and trade. And I think one of the things that I look for, what you just talked about, setting stops, one of the things that I look for, and I don't set stops if I'm in a trade that's short term, I'm looking for areas. And one of the things that I will do is I'll use what you just described as an area to look at, to go and look at tape and see, is it a fake out? Sometimes we can tell and sometimes we can't. And I agree that I think a lot of the traps that you see out there are the market maker or whoever else is coming in that may have actual intentions to a different direction, but are really good at faking out everybody off of the open and generating that little pocket of supply, trapping them and going the other way with their real intention. And I think that can be a really difficult thing for new or novice traders to identify and catch. And that's where I think using those anchors from previous days, and or just using the VWAP from those other days to say, hey, maybe I should just kind of chill out until I get this area, and then look to see if I can find some change.
I couldn't have said it better. I mean, I think that, I always refer to them as a level of interest, not necessarily a place to do business.
Yep.
And when it gets to that level, then, maybe my alert went off, or maybe I was just watching it in that area. And then perhaps I'll look at the level two. I look at the level two when it's time to enter.
Okay.
And if I start to see the speed of the tape, quickening a little bit, or just little clues in there that I'll see a big offer and it gets gobbled up really quickly. That old adage always comes to mind, price moves to size. So most people are scared of a large offer, maybe 5-10 cents above where the breakout is supposed to occur. But what you'll see often, as is it runs up to that level and it just chews right through that very quickly, and then the stock is off to the races. So you've got to be anticipating in that zone. You've got to be on high alert to say, this is my level of interest. Start paying attention if you weren't watching it already. And that could mean look at your 1 minute chart, refer to yesterday's anchored volume weighted average price, the year-to-date anchored VWAP, if that's important. And it is right now in the market, because the NASDAQ, we're sitting right on it 3 days in a row. So it's good to be aware of all these levels and how they tie together for that multiple time frame analysis, where we can get our edge as best as we can and know where our stop is and get the hell out of there quickly if the market disagrees with our assessment.
Yeah, and it's funny that you say that. I always, and I definitely use some of your catchphrases, especially since you have been, since I've been following you and looking for areas as an area of interest and not to do business. We like to say it's part art, part science, and those are areas that are not definite areas, but they're definitely areas where things can happen, and we are looking for things to happen. And, in the past, the way that I was trained was using, I didn't have Anchored VWAP back in the day. And then mostly what I was looking at was, okay, are there moving averages that we can use to find change in that level 2? And that's kind of how I had to figure out, where were good places to buy or sell. So the anchors just make it a lot cleaner. They make it a lot easier, especially for those who struggle to read level 2. And to be honest, it's difficult to read level 2. It takes a ton of concentration, and you really got to be dialed in, and mentally it can wear you out if you're watching all those numbers and shares ripping across your screen for 4 or 5 hours. It'll take a toll on you.
Yeah, it's exhausting.
So I want to ask more questions about the book, but before I do that, I just wanted to get, I've been listening to a lot of your interviews recently, and I don't think people are. I would like to know a little bit more about you. You live in Colorado, is that right?
Yeah. Yep.
Do you live in Denver, or are you up in the hills? Where are you at?
I'm in Denver. Yep. I've been, in Denver. Actually was born here, 1967, and moved back in 1991. So technically I'm a native. You see all these clowns with their stickers that says they're a native. So who gives it, whatever.
Right. I spent a lot of years in Colorado. My kids were born there. And my youngest is set to graduate from CSU in the spring. So
nice.
Last one on payroll. So that's nice to get off of the payroll.
Well, it seems like they're off payroll, right? But then there's always little incidentals.
Exactly. There's always the incidentals. So I spent most of my time close to the DTC area. I lived in Evergreen for a little while, and then when the kids were born, I had to teach them how to ride a bike on flat ground and not get chased by the bears. So it was a good idea to get them out of there and down the hill. Do you get out and ski much in Colorado, or do you have any hobbies that bring you outdoors out there?
Yeah, so it's ski season now, so that's my focus.
Yeah,
we're actually, my wife and I got into the backcountry skiing kind of through COVID. Some of the resorts were closing. We still wanted to get out there, so we took some courses and rented some skis, then bought all the gear. This weekend we're doing a avalanche safety course. It's a 2-day thing. And then next Wednesday, we'll be spending 3 nights in the backcountry, up just above Georgetown, actually. So, the area, you know where that is.
Yeah. So, above Georgetown, I thought that a lot of those avalanche classes were done up at Berthoud. So are they kind of all over the place, or?
The classes are done all over the place. We're going to a place called Bluebird Mountain, which is a backcountry mountain. It's the first of its kind. There's no lifts. You're allowed to bring dogs there as well.
Oh, that's awesome.
They have barbecues, and it's a cool vibe.
That's awesome. So, are you a true tele skier, or do you put on skins and have a free heel and lock it down when?
Exactly.
You go?
Yep. Yeah. So the technology there is just exploded in the last 5 to 10 years.
Mm-hmm.
So it's AT, they call it, alpine touring skis. And you put the skins on, you go up. There's no lift lines, but there's no lift. Like they say, you earn your turns, and just the solitude and the beauty of and not having crowds and bumping into people and people coming out of nowhere on the mountain. It's just a quieter, more, there's risks, of course, and that's why we're getting the training and got all the gear and the beacons and the shovels and
beacons and pecker poles and the whole bit, right?
Yeah.
When you go up, do you ski with a large number of people, or is it just you and your wife that go?
My wife and I go a lot with the dog. This will be a group of 8 people at the lodge. The hut, basically. It's again, it's off of Guanella Pass, so that pass is closed during the winter. But you kind of take one of the little side chutes and up one of these dirt roads that leads to the cabin. But obviously, it's a snow road now.
Yep, that's awesome. And then so you were a native, you left, you came back in 92. Did you go right into the brokerage business in 92, or how did you get your start in this world?
Yeah, 91. Right out
91.
of college when I graduated, I took a job at a little company called Thomas James
Oh
in
yeah.
Boston.
Okay.
And, they were kind of like one of these boiler room operators. I stayed with them for about 2 months and hopped over to Lehman Brothers. And at Lehman Brothers, I learned how to sell. So that was really an important thing to learn. And I worked with the top producer in the office, who kind of took me under his wing a little bit, and
Mm.
he was using Investors Business daily charts, the daily graph books, the
Yep.
green and blue books. And he would buy stocks of companies that reported positive earnings surprises. So I kind of got a little bit of the little bit of the can slim
Yep.
type approach, marrying fundamentals and technicals. But what I found, Ron, was I would start to believe the stories too much, and I would ride these stocks down and continue to justify it. I'd pull up the value line and say, well, it's the, and look at, pull up the new research report that comes out. And, so that's how I learned that really risk management was most important. And I kid around that, as a retail broker, I got to practice with other people's money for a couple of years. So
Yeah.
I moved to Denver in 92. And then I left. So I worked at Dane Bosworth downtown, and left them after about a year. And, I just didn't want to be a salesman, basically. I wanted to be a trader.
Sure.
So I worked for one of those companies that, used to read about in the back of the IBD, put up 25 grand and we'll give you a 20-to-1 leverage.
Yep.
And that sounded like a great idea to me. So, that's how I started. And I couldn't afford to lose. So I was extremely risk averse. I mean, it was all my money in the world, plus some borrowed to get started. I was, 23, 24 years old, whatever it is, probably 22 actually, because I'm 55 now. So, I just had to make it work, basically. And it taught me a real appreciation of risk management. And I've seen, over the years, I've seen thousands of people come and go in the trading world. And, they're all superstars when the market's red hot.
Yep.
And we saw it this last cycle. And they're cocky and they're loud as can be. And,
yeah,
part of me, you're like envious of the money that they at least claim that they're making when it's going up, because they have no regard for risk.
Yep.
But then they, we know what happened to them. They gave it all back, and now they're back at whatever they were doing to, make a living, because they didn't respect risk. And that's the most important job. The earlier you can learn it, the better. So the people in the last cycle who made all that money after the stimmy money, and
that stuff went away fast, right?
Yeah, they learned it fast, and that's good, So they've all gone back, they've been bit, they've got bit by the market bug, and then they lost all their money. But now they have that. They know that it's possible, and they can go back and get education, find mentors, read books, take courses, whatever their best way of learning is, and slowly get back into the market, because that's ultimately, as we know, the only real way that we learn. We learn the principles and that sort of thing. And that's, as you referred to earlier, that's the art of technical analysis. That's the art of, the science of technical analysis. Then it comes down to the art of trading, which, as we know, is a lot more difficult than just, memorizing patterns or even the motivations behind those patterns.
Yeah. Yep. What got you interested when you were going through? And by the way, I think I was running around in Denver. Do you remember Oldie Discount,
Yeah, of course,
the retail brokerage firm? So I think you and I we probably crossed paths professionally at that time. I was in Denver, and I was working as a retail broker for Oldie Discount. And that was back in the days when the bid ask spreads on the NASDAQ stocks were ridiculous. And we'd make a market in those stocks. So the big deal for Oldie back in the day was, hey, if you buy 1,000 shares, it's commission free. What they don't tell you is you've got to place that order as a market order. So if you're buying something with a $3 spread, you're immediately down $3,000 on the trade. But as the broker, I get a piece, and the trading desk made the spread, and they made a lot of money with that model, a lot of
That
money.
that was, not to go off on a tangent here, but that's what I saw at the first firm, which was Thomas James, and I
Uh-huh.
just knew it was wrong because that back in the day, and I'm not sure if it still is, but the maximum commission you can charge is 5%. And the manager would come out and say, "Hey, we've got 1,000 shares of Dynagen. It's 5.5 with 3/4 of a point."
Mm-hmm.
And what that meant was, the spread was maybe 4 by 5.5.
Mm-hmm.
And here we are, just a bunch of, kids who just,
Yeah.
got their brokerage license,
Yep.
being told, "Hey, you're going to get paid an extra 75 cents a share for selling this stock." They tell us a great story. We go repeat it and we make this big commission. And as you said, the customer would be immediately down 25%.
Right.
And, I kind of looked at that and said, just doesn't feel right. So fortunately, I got over to Lehman Brothers, where they're dealing in real stocks,
Mm-hmm.
and, worked with, the top producer in their office. So I was fortunate. I was able to see that and get away from it rather than get sucked into that easy money Wolf of Wall Street bullshit.
Yep. Yeah. That was a brutal environment. For me, it was Monday through Saturday, and it was from 6:30 in the morning, and that was Rocky Mountain time, till
Yep.
9 o'clock at night, and then on Saturday mornings from 9 to 1. And if you didn't make your 300 dials, I mean, they were pretty ruthless, and they were not, management in those places were really not nice or good guys. Like, they didn't care if you didn't hit those numbers, and they kept track. Like, they would, there was all kinds of nasty stuff that would get said, and people would pack boxes and leave if they couldn't hack it. It was not a good environment, and that was
The most
the same
surprising
thing.
thing there, Ron, is that, I always kind of thought Oldie was just, like Muriel Siebert's discount brokerage
Right.
firm,
Right.
right? And
Yeah.
I thought it was more respectable than that. I didn't realize they were playing the same games that, the little schlock firms like Thomas James were doing. That's
If
kind of crazy.
if you go and look up on the web, and you just do a search on Oldie, you'll find all kinds of articles, and there was a class action filed against them, I think, by a group of women who just were not happy in the environment, and it was a really misogynistic environment. So I think that those women were in the right, and they got paid because it was not it was not a friendly environment to anybody, but especially
Yeah.
to the women that were in that environment. So yeah, it taught me a lot, and similar to you, it taught me the desk is making the money, not the broker, right? And I kept looking at that, and similar to you, was looking at it and thinking, well, the way I was trained was, you tell the customer you buy the stock. Why? Because it's going higher. That's the sales pitch. And I was like, well, okay, that's great for the desk. It's not good for my customer, because if I blow them up, they're going to leave, and then I've got to go find new ones. And it's really hard to find new ones. It seems easier for me to learn how to be a trader than it does for me to sit here and continue to call people at dinner time that I don't know, and try and get them to give me their money.
Yeah, I mean, dialing for dollars. That's why you had to keep doing it, because you'd blow them up. And just one last thing about this was, saying that the managers weren't nice guys. I was told initially at Thomas James during my trainings, your customers are like, treat your customers like mushrooms. Feed them shit and keep them in the dark. And that was an honest to God like phrase that the manager of the office would tell us, that
Yeah.
this is how we conduct business. I'm like, that's a cool phrase, but that doesn't seem right.
You're not going to have good customers after that. They're definitely going to go away. All right. Well, thanks for sharing that. It's good to know. And it's interesting that we had some overlap in that area. I moved out to California in 2002. So my Denver chapter, I think I spent 15 or 16 years out there, worked up in the mountains, and then came down and, finished up on the Front Range with the kids, but left from there. So back to your book a little bit. There are a couple of things that were enlightening to me. The pinch is a very, very interesting observation, and it works quite well. And we've been using that recently. And, you know, the first few times that you see anything, you look at it and you're like, that's amazing. Let's see if that actually will continue to repeat itself, right? You just, as a trader, you're just skeptical of things
Of course,
to begin with, right? And then, you know, it keeps repeating, right? If you can find it and identify it, it keeps repeating, and you have a really nice edge, where a lot of traders will say, okay, the end of the day is controlled by algorithms. But if you can identify spots where this is where those algorithms are, you know, could show up, and the probability lies to one side or the other, that's a pretty nice revelation. And as somebody who likes to scalp, that's a nice place to be in. How did you come up with that observation? Did it just dawn on you, or had you been watching it for years? How did you come across that?
My first exposure to the VWAP was in 2003.
Mm-hmm.
And it didn't show like the way it does now, as a, you know, similar to a moving average. Instead, it was a horizontal line on the chart. But I started noticing that, you know, if I draw it from 4 days ago through today, it hit it yesterday, perfect. You know, that pullback yesterday afternoon hit it just dead on, and then bounce from there. Mm-hmm. And then I'd pull it, you know, start it from that low, and I'd pull it over to the right and say, wow, the high hit that to the penny and pulled back. So I started, you know, in 2015, TC 2000 are the first ones that, you know, did a point and click anchored volume weighted average price. And I started just, you know, geeking out on it hard. You know, I already had been geeking out on it, but this is when I could really, you know, just point and click and draw 100 of them on a chart if I wanted to. And I would sometimes do that. And it sounds, you know, a little silly, but I would learn by doing. Here's where the key levels are. Here's where, hey, notice how that little low in the morning and that afternoon high, the stock just kind of ping pongs between them and then compresses that energy. And a lot of times that would be, you know, it might have dipped through the 50 period moving average. And you'd be looking at going, well, it's now broken because it's through the 50 period or the 100 period moving average, 1 minute chart. But it breaks free of that and, you know, bounces from the low of the VWAP from the low, finds it perfect, comes back, hits it, and you just see a ping pong in between. And it's just like, you can see it developing that energy and that it wants to break free of there. Now, it doesn't mean it's always going to, but you know, especially the tighter it gets. I see sometimes people will say, hey, Brian, it's pinching between that high at 70 and that low at 30. And then, you know, there'll be a 20-point range between those. And that's not really a pinch. It's just between those. Yeah. A pinch means the energy is compressing and it's getting tighter towards the end of it. You know, it's really similar to classical, you know, technical analysis, a symmetrical triangle. It's kind of the same thing, but it gives us the opportunity to say, where are the boundaries of the true boundaries of that? And how are they represented by supply and demand objectively, rather than just trying to squint and create this pattern? It gives us the truth of the supply and demand from the low in the morning, the truth of the supply and demand from the high. And once it comes back into equilibrium, then we look at, you know, the definition of trend. Once established, more likely to continue to than reverse, and the higher time frame trend takes precedence. So if the primary trend is higher, it's pulled back and pinched, we expect it to break higher. So we're anticipating that. Once it starts to break, that's your entry. And then, of course, if it fails, for me, I want to base it on the definition of trend. This is the first higher high as it comes out of that pinch. So I want to put my stop below the most recent relevant higher low, because if it breaks that low, well, my definition of this emergent trend, higher highs and higher lows, isn't there anymore. So I've got to be out of the trade. Otherwise, I'm just bullshitting myself.
Yeah, I get it. Do you ever base anything? And one of the things I think a lot of traders come to us with questions about are things related to risk management. And I think that there can be a lot of either misinterpretation or having the tendency, instead of using that type of a technique, but to say that their risk is based on what they're willing to put dollar wise into the trade. I personally think that that's the wrong way to go about managing the risk. I personally think that you're looking for what you're looking for. And if that means if you have $1,000 of risk on a trade and, the area that you need to stop out at means that you're going to lose, you have the potential to, let's say, lose $700 in the trade. I would prefer to look at the area from a technical standpoint of where that supply and demand break, is going to break down versus, I can only tolerate a $500 loss here, and therefore I'm going to tap out. So do you have a perspective on risk management from those two schools of thought?
Sure. I mean, I think that what you're describing is, best, who came up with, now I can't remember. It's, I think it was Van Tharp who came up with the concept of R multiples. And if you say your maximum risk is $500, there's nothing wrong with that. But what people get confused with sometimes are, some of the principles espoused by, how to make money in stocks, the Cancelim method, which is, never risk more than 7% of your capital. Well, for, certain timeframes that might be appropriate, but what's more appropriate is, again, the definition of trend. So if I look at that stock and I say, well, my stop is $1 away, then it tells me I should do 500 shares. But if it tells me, my stop is 25 cents away and my risk is $500, all things equal, I should be able to trade 2,000 shares of this stock, because if I trade 2,000 shares and it pulls back a quarter, then I'm going to lose that same $500. So I think that kind of makes it more formulaic, which is what people want. There has to be that justification for that, what we're all taught of 1.1 part risk for 3 parts reward. And that's great in theory, but oftentimes you'll get into the trade and you'll say, wait a minute, the whole market just fell apart. My stop is 24 cents away, but I see the handwriting on the wall. I see 3 other stocks in the sector breaking down. I'm going to take a 2-penny loss because it just doesn't feel right. And that's where, again, as you alluded to right at the beginning, it's the art of trading versus the science of technical analysis. We can learn all the stuff and be great book learners and memorize all the candle patterns and all the heads and shoulders and tweezer tops and all that stuff. But if you don't understand the psychology of the market, and more important, your personal psychology and how it interacts, you're just going to be dead.
Yeah, good point. The other thing that caught my interest, and I don't want to go through every single detail in the book, because first of all, it's an amazing book. It's what I really like about the book is that you take a lot of detailed information and you put it in the book in a way that, even if you're not from a technical background, it's simple to read. I think that there's a real skill in being able to take a complex topic and put it in a format for a large amount of people to be able to get through without having to go reread it 6 or 7 times, or after they've read it, say, I don't understand what I just read, and giving up. So I think it's an amazing book from that standpoint. But the other things that caught my attention, and I'd love to have you pull a chart up, is you talk about gaps and you talk about different types of gaps and how you use the anchors on gaps. And one of the stocks that we've recently been trading and looking for a continuation of downtrend is Domino's. And I'd love to get your commentary on how you would go about evaluating that gap on Domino's and using the combination of first of all, what kind of a gap would you call this, and then second of all, how would you apply anchors or VWAP to these trades, like how you describe in the book?
Okay, so yeah, first of all, I want to address the compliment you gave me about the writing of the book, because that means a lot, and it was really a lot to do with my wife. She, if it hadn't been for her, going back and forth and saying, Brian, this might seem clear to you, but you're going to lose readers here. And I would get frustrated and say, I just explained it 4 pages ago. But you need to remind them here. And anyways, she was amazing at, making sure that people got it as it went along. So that is a a real high compliment, and I thank you for it. So let's
Yeah.
look at dominoes.
Yeah.
First of all, we'll start with a longer term time frame.
Right.
And here, this is going back to '09. We had an important low, so we can put a VWAP there, and that doesn't help us, right? You could say, so someone might tell me, hey, Brian, it's pinching between the '09 anchored VWAP and the one from the high last year. I was like, well, technically, I suppose you're right, but what a real pinch is tighter. So, I want to look at where's the last place it touched at, and that's what I refer to in the book as a handoff. And then it touched it here, and it didn't really touch that. So I'd take just these important lows and kind of go from there and see what we're seeing. So now let's just kind of clean it up a little bit and go back to 2017 low. So just first, what it means is that the average long participant from this point in 2017 is now losing money. We know that because the average price that it traded at in that time was 328, basically. So not all of them, of course, and that's not what we're trying to prove. What we're saying is, since that low in 2017, 5 years later, how does the average long participant feel about this stock? Well, the average participant is losing money. The average participant from this low is losing a lot more money. And we can see that, we often get bounces from these levels, and they're not always precise. Again, that's why it's a level of interest.
Right.
And we break down, and now it's maybe finding resistance at this level. So looking at this big picture, just technical analysis 101, this could be a shoulder, a head, and a shoulder for people who are into that, right?
Mm-hmm.
So taking a little bit just basic technical analysis again, we've got a declining 10, 20, 30, and 40-week moving average. That tells us that the institutions are getting out of this stock. A lot of people fall for these rallies above the declining 40-week moving average because, hey, it just went from 300 to 410, it just rallied 35%. That must have been the low. And they get surprised when it does this again. So, now what I want to look at is what's really most important here. We had this high at 400 and dropped to 325. That's 75 points. We had this high at 375. If we take 75 points out, it kind of just met its measured move objective. If this is an A, B, C, and this would be D. So what we're looking at in a measured move is the first leg, A to B, we get a bounce, and then the next leg lower should approximately equal that 75 points. So it met that objective. It undercut this low slightly. Right? If I drew it horizontally, we would see that. It came down on real heavy volume. Heavy volume tends to peak at turning points, like we saw over here, right? That volume increased on the way down, and the maximum volume was right on that low bar. It rallied on light volume, came down, and the biggest volume was on this low right here. So we rallied on lighter volume, came down on hard volume. So it's telling us maybe we're in a zone that a lot of times, the people who want to short it under here, they're generally going to be a little bit late because the short sellers who are looking for that measured move, A to B, B to C, C to D move, might have been looking at it and saying, hey, that's a great place to start to cover some of our short. It's also a slight undercut of this low. When it undercuts that low, it's often a place where the uneducated short sellers get involved. And I'm not saying, the bigger picture ones, not the short term. So I'm just going macro first. So then down to the daily time frame, in the book, I talk about the different types of gaps. There's the breakaway, the measured, which is also called the running, and the exhaustion gap. This is probably a measured, so somewhere in the middle of the bigger downtrend. So I look at it and say, it's come down hard 4 days after that, and the bottom, the people who thought it was down too much basically got what they deserve for buying this stock, as the institutions were saying, we don't want it.
Right.
Now we anchor a volume weighted average price to that gap. And you can see that first rally the next morning, that's where the sellers said, we've got more to do. We're not done here.
Yep.
So they defended that. And now they defended it early this morning, and later in the day, it came up. So I want to put an anchor right here at the low. So what we're telling is two stories of supply and demand. The supply is in control from this point, from that anchor point.
Mm-hmm.
The demand is in control from this anchor point. So I don't want to short it yet, because maybe it does this and turns around. We just don't know, right?
Yep.
So what I want to see happen is maybe it breaks free of this little pinch that it's in, right?
Yep.
And gives a false move to the upside, comes back down and does something like this in the next day or two. And if it was to do that, and this would come back down on top of it, this one, so we get a little false shake higher that gets bottom fishers excited for a day or two. And then as it breaks down, let's say tomorrow below the 2-day volume weighted average price, so the one I just added here, tomorrow that might look like this. And then, we want to maybe get involved over here with a stop above this level, thinking that now it's ready for the next leg lower on the bigger time frame. So it's about putting them all together and, just letting, so right now I kind of think that looking at it from a short perspective, it's in no man's land. It's too early, it's too late to sell it short for the bigger time frame, and it's too early on the shorter term time frame.
Yep. I will say that I will look at a move like that and use just VWAP off of the last 2 or 3 days of trading, and look to see if I can catch continuation of that move. If it doesn't work, and typically what I'm doing is that, again, we use options. So we have a different time frame, we have a different capital risk outlay. A lot of things are different that give us a little bit less of a risk profile when we're trading that way, because oftentimes, to your point, I know that there's possibility that we're going to bounce there. There's also possibility that the selling picks up. So I will go in there and I will look, with small contract size to do that. But on a day like today, when it, is making its way back up to that anchor, I just burn the trade and wait it out, and then look for and continue to look for the opportunity to catch that with a little bit more time and for a more significant type of move. So I find the anchors really helpful. They helped quite a bit to look at it and say, in that little rise that you had today, where it broke to the upside from those anchors, is about the spot where we said that's enough. It's not the right spot, and we'll just come back and revisit it when it gets to some of those levels of potential resistance again.
So Ron, are you talking about, for instance, the anchor from the high that, you can see that it held it back? The sellers were trying to hold it back.
Yes.
And they lost control right here.
Correct.
Is that about where you exited? Is that?
Today's March 1. So that's about where we took that off. So this is, what's your time frame on this chart? 5 minutes.
Yeah.
So we were actually a little bit further back. So this off of the open, this big move higher. Yep. There was an anchor that broke earlier that we were looking at, and that's where we got out. So we didn't get stuck in that big move higher. We got out before that big move higher took charge. So that it was a very minimal loss, and it was just it's one of those things where you admit that the continuation of what you were looking for is not there. You step aside, you wait, and we'll come back, and we'll look for that opportunity to come back.
Yeah, you can't afford to get run over. And
no.
And I'll just say, when you ask me to look at a chart, I always look at it I was trying to give a little bit of extra just by looking at the longer term time frame, because you asked what kind of gap it is. But
Yeah.
my lens that I see the market, that I try to engage, is the swing traders time frame.
Yep.
The market this year hasn't provided, January we had some good follow through on the upside, and February had been a really choppy month, and we're continuing that so far. But it's, that's my preferred time frame, so that's my bias and we all have that's my time frame bias when I look at a chart.
I look at and we do things similarly when it comes to how do we evaluate the market. Typically what we'll do, I would prefer, it's my preference to be a bull on something. And in this environment, it's very difficult to find something to be bullish about from a long-term perspective. As you like to say, the market is guilty until it's proven innocent.
Right.
And the trend for the last 14, 15 months has not allowed you to have the luxury of saying, we're just going to get long something. It's just not, it just doesn't exist yet. So we haven't had anything. And if we do find something that we like from a fundamental perspective, we have to go back and we do the breakdown. We look at it on a weekly chart. Then we come in and look at it on the daily, and we try to make a determination of, is it in a spot where from technical analysis that it would be okay to look at maybe a quarter position. But again, we're using options. So we're not putting the same capital risk that's out there. We're we're taking an option that's in the money by a specific type of risk parameter that we're looking for based off of delta, and then we're trading around that position, and we've got to come in on tighter time frames to do that. So when I look at something like a Domino's, I look at it and I think, well, this probably has a combination of short-term and longer-term potential, but because of how the trend is, I can't look at it and say, I'm going to try and catch it for a bounce up. I'm looking at it and saying, I think that it's going to reach an area where it traps people and continues to punish them to the downside.
Yeah, I agree. And, a lot of what you just said there is, how I've been handling this market as well, is that it's not an environment where you can just sink your teeth into things. And you alluded to a quarter size position.
Yep.
I look at it in terms of A, B, and C risk ideas, and A list ideas, a full risk unit. And I can't remember, I think I've had maybe 2 or 3 of those this year. And a handful of B list ideas, which would be a half a risk unit. And just, and most of the stocks are, they're just ideas to have ideas that maybe something takes off, but just low confidence C list ideas, a quarter or a third risk unit. That's the message of the market. It's
Yep.
about listening to the market. And it sounds like, you're right on that same page.
You have one of the things that I was taught early on is that it's imperative to have, and one of the things you alluded to, especially with the CanSlim method, is it's imperative to, if you're looking at something long-term and long-term upside, to have not just the fundamentals put together, but to also have the technicals in your corner to give your position a fighting chance. And one of the things that we also look for is, are insiders buying? Is that anything? Do you put any of those things into practice? Do you like to find things that last for more than a swing trade, for more than a few months? Do you like to find something that you can hang on to for a longer period of time? And generally, I don't necessarily care about what a company does or doesn't do.
Right.
As a trader, I'm looking for the activity as opposed to the story. But longer term, I like to try and tie some of those things together. Do you look at it that way, or do you have a view?
Yeah, I think longer term, you want to have some basic fundamentals in your favor. For me, it's always, just real basics. Are they selling more stuff? Are they making more money selling that stuff? So in other words, increased revenues and increased earnings. And those, and then if I can, look at it and say, here's what the company does, and it seems like, it makes sense that they would continue to sell more of that, then, and it's supported by the chart, then it gives me a little bit of extra confidence to maybe hold partial position a little bit longer than I might if it was just a chart idea. As far as insider buying goes, that's not, it's a small piece. It's definitely a nice bonus to see that. But in terms of, if I were to say the weighting that I give it, it's maybe, 2 to 3% at most. But it's great to see that the, insiders are supporting it rather than, here's a stock that you might be familiar with. I was just looking at this one recently. And they seem like, they got a billion, several $billion contract to provide, I think, Lockheed with satellites. And I looked at it and go, wow, it was up on big volume. It hit the 200-day moving average. That's great. And I looked at what this company does, and it seems like, this thing could grow massively. And then I looked at the insiders, and there's this group of insiders who has sold it, from they began their selling, their 10% holders. I just looked today, and they sold like 4 million shares up in here, and now they're down under 10%. But if I see that happening, I'm like, well, why are these guys selling it? If Lockheed Martin gave them a $100 million cash infusion, and this other company bought 7 billion, a bunch of huge number of satellites. So I'll look at that and if this stock were to, act the way you would think it would based on its fundamentals, it might be a good stock. But I look at it and say, forget the story, because now the stock is broken and I've got no business, being involved in this trade.
Yeah.
And I don't mean to run on here a little bit, Ron, but I want to talk real quick about, some of the stocks that I've been looking at. They're set up. I mean, they're ready.
That's on my radar too.
They're that one, Fortinet, they have the same types of charts, BSY. Yep. They've, and here you can see I've drawn on this one a little bit. But this is, just classic stage 2 uptrend, stage 3 distribution, stage 4 decline, stage 1 accumulation. And if they didn't scare you out here, it took a year to wear people out. And it's just ready to go. And I was telling, my subscribers that, if you ever watch those gold shows on the Discovery Channel, they're digging under the ground, and the Discovery Channel always like draws in this giant pile of gold just underneath the surface. And I said, when I draw this isn't meant to be a price target or anything. That's the Discovery pile of bullshit gold. But I'm just saying, if it were to unfold the way a stock is supposed to through the 4 stages, this one is as close as any to becoming that type of stock that could break out of there. So we look at the shorter term time frame, and we say, it's holding the year-to-date anchored VWAP, and that's also the 50-day moving average right in there. And then we look at the anchored volume weighted average price from this low, for instance. And we're having trouble with it. It tried to break higher, but it was extended. Now it's got, this is what I was hoping it would do. I drew this in last night. I was hoping it would do this today. Instead, it fell apart. So, I look at all these charts and I look at this great potential in them, but so many of them just keep failing. And you can't let that Discovery pile of bullshit gold and, this chart that looks like it's entering a stage 2 uptrend, trick you into holding something while they fall apart, and they've been falling apart. There was one I liked 3 weeks ago. I held off because they were due to report earnings. They reported earnings. I mean, it looked like a beautiful,
they got crushed.
Yeah, it looked like a beautiful breakout. It was above the anchored VWAP from the IPO. That was clearly a resistance level. It was a battleground. And then the earnings came out and just lights out.
Yeah, we always clear out of the way before earnings. And if we're in something that's longer term and we have some cushion, we're always getting some kind of protection going into that event, because you just don't know.
Right.
You just don't know. Awesome. Really nice, clear breakdowns of how you go about it. And I see a lot of similarities in how we approach things. I think that you've been doing this much longer and are much more tuned in. And we've learned a ton from, I've learned a ton from watching you. And we'll have Matt put the links to your website and service, as well as your Twitter handle. And, guys, please make sure you give Brian a follow. And, it's every Friday you give a breakdown of what's been going on in the market. And, I always make a point to post that in our rooms. I think it's a great breakdown. And, we, again, what you do is an arrow in the quiver of the big picture of what we look at. But I think it's a very important one. And it's one that we utilize a lot, and we find it super, super helpful. And I think you also, at your service, don't you offer a free trial period? Do you give people like 3 days or a week or something like that, or how are you set up?
That, then you get all these people with 20 different emails.
Oh yeah. So
in. I do a 2-week $59. If you
there you
go.
If
you like it, you like it. If you don't, I'm not here to convince you otherwise.
Yeah. That's great.
But yeah. So thanks for mentioning it. I'm not a big promoter of these things. I think the best way for people to just look at my work is to look at my Twitter. I post a lot of stuff on there, and if you're an adult who can make your own decisions and want to just get some guidelines, then you might want to take a look at the service I offer. But if you're looking for me to hold your hand and tell you what to do, that's not what I do, and I'm not here to convince anyone that I, similar to what we were talking about, the clients as a broker. That if you just trick them from the start, you're just going to lose them. So it's about, mutual respect. And if you like what I'm doing, stick around. If not, not a problem.
Yeah, that's great. We kind of have a similar philosophy. We teach people how to fish. We don't hold their hand and tell them, here's where you enter and here's where you exit. We're trying to teach them something that's sustainable, so that one day when they don't want to be in a service, or they want to do it on their own, that they're able to continue to ride the bike without the training wheels.
Exactly.
Yeah.
Got the bears getting at them.
Yeah, exactly. About the bears catching them. So Brian, we're at about an hour now, so I don't want to take any more of your time. Thank you so much for joining us. I hope you give us a follow back on the Twitter machine as well. And guys, the name of the book, again, we'll put the link up for the book as well: Maximum Trading Gains with Anchored VWAP. And here it is again. And Brian, thank you for joining us. It is a definite pleasure having you on, and I'm glad we had an opportunity to connect face to face.
Yeah, great. Thank you, Ron. And
all right,
good luck to all your members, and keep trading well.
Yeah, thanks, you too.
All right.
All right, Brian, have a good one. Bye.